All right, good evening, happy Sunday. Happy last day in the month of April 2023. Today is Sunday, 30th of April. It's wonderful to have us. I'm holding this call today because I want us to, let me first of all guide our new team members, the likes of Maureen, the likes of Uche, the likes of Ibrahim, and all of that. Then Emmanuel as well. I want to see how to guide us through. I gave assignments. I'm expecting the response for those that have not responded. Mr. Bulu, welcome, our resource person. Thank you for hopping on as well to join us in the call for tonight. All right, this is week 25. Let me just show us what I want to teach. Basically, in the mentorship, I stress on structure. Then after structure, I stress on liquidity. Then after liquidity, we talk about entry. We have a lot of courses or tutorials in this regards already. So tonight, for the sake of those that are joining us new, let's just do a market structure recap. From the higher time frame. That's how we title this. Market structure from the higher time frame. Okay. This is what I want to talk about tonight. Market structure from the higher time frame. The highest time frame or the higher time frame starts from monthly, yearly, weekly, and all of that. So just if you come to this end, for those that are new, you will come to this flyout tool here. You will see the time frames, the biggest to the smallest, from 12 months to 6 months, 3 months, just like that. Therefore, most of us who trade synthetic, we have daily, because the synthetic chart does not have weekly. But the MT5 has have weekly time frame. So weekly, a higher time frame in this regard, I'll be talking about weekly, monthly time frame, then daily, and probably 4 hours. 4 hours. So I'll talk about monthly, weekly, daily, 4 hours. This is the time frame I refer to as the higher time frame in this regard. So let me put it like this. I'm going to be talking about weekly, or let me start from monthly first. Monthly, weekly, daily, and then the 4 hours. So this is what I will refer to as my higher time frame. So I want to look at market structure from this higher time frame. Market structure from this higher time frame. Remember, we have entry techniques or components we use in the Smart Traders Network. The components we use in the Smart Traders Network, the components or smart money. We call this smart money concepts. These are what we are going to be using all throughout our trading. The components, we look at them step by step on what they are. First of these components, we have structure. Number one is your structure, any day, anytime. By structure, we're talking about from the higher time frame, monthly, weekly, daily, 4 hours. Then we look at the range, or let me say trading range. By trading range, I'm going to explain. We're talking about the most recent high and the most recent low. Recent highs and recent low. Number 3, talk about the liquidity. By liquidity, we're talking of where are previous buyers and sellers. Where are previous buyers and sellers? Then we'll talk about the banks. By banks, I'm talking about the mitigation candle. I'm talking about institutional candle, fair value gap, and where the money is hiding. That's what we'll talk about when I'm talking about banks. So, like your other blog and all the smart money play we've looked about, this is all called banks, or this one referred to as banks. Then number 5, we use our fib levels for extra confirmation. The fib levels. We know that in the fib levels, we have entry. We enter at discount zone and premium zones, and then 50 is equilibrium. Then once it's discount zone, we can get an entry and just stuff like that. So I'll just explain them gradually, how we make use of these components. Like in other materials we've made, we have stressed about structure. And I said that when price is bullish, we have 2 major forms of structure. Either it's bullish or it's bearish. There's consolidation phase when the price is trying to move from one phase to the other. We refer to that as consolidation phase. Price is giving you a series of higher highs, higher low, another higher high, higher low, higher high. Price is not just going to turn like this and break this low. Most of the times, price can give you something like this, and then it will stay here for some time. Stay here for some time, and then it will breaking this last low. Once this last low is broken, we expect that price comes back, and then price changes direction. It will now start moving in this order. So you see a high, a low, higher low, another higher high, higher low, another higher high, higher low, higher high, higher low, higher high, and then price comes and give you this break. Once this is broken, this is referred to as a break in market structure. It's giving you a signal that this buy trend, this upward trend has come to an end, and then the bearish trend wants to resume. So the bullish trend has come to an end. Immediately this break in market structure happened. This break you can find here. Then you want to wait for price to return back. You want to wait for price to return back to that last push up, this push up that took out this liquidity, because this is now treated as liquidity. You can see how the price cleared it away, and then it gave you a low, gave you a higher high, and broke the higher low. Once this higher low is broken, then you want to wait for price to come back. This is now called entry. This is our trigger point. This is our trigger point, entry. We're getting our entry at this zone, because price gave us a break of structure, and then price came back to that last push up, this last push up. Price traded back inside and then give you that entry, then we'll start coming down. Now, this phase that you see here sometimes can be referred to as consolidation phase, because sometimes price can stay here for hours, like hours, and then price just keep staying around that region and will not go anywhere. So that is what we call consolidation phase. But basically, price is either giving you this movement or giving you this movement. Either price is giving you this movement or this movement. And this movement must be spotted on the higher time frame, either monthly, weekly, daily, and the 4 hours. We only go to lower time frames like 2 hours, 1 hour, 30 minutes for entry. For entry, that's what we do. So Assuming price is now giving you all of this. First is structure. Price is going up. When price is going up, you want to identify the next your trading range. This is the low, the most recent low, when price was going up. Immediately price started coming down. That is when you identify your recent high. What it means is that you're going to be looking for entry around this higher low. Once price validates the higher low, that trade setup is no longer valid. Once price closed below this higher low, your setup is invalidated. So you want to wait for another setup to get an entry. We take entries only on the trading range. So first, the low and the high. That's your trading range. After you've known that we are bullish, we are going up, because price closed above this high when this low was created. Immediately this high was created, then this low becomes valid. As price began to retrace, you want to wait at this zone for entry. You want to wait at this zone for entry. So there is a course on entry, which I've already talking about time frame analysis, correlation of time frames. That's how you get your entry. It's in the library section. You can just search it out and go through that particular video. So once price gives you another high, trading range will change. This becomes your last high, and here now becomes your last higher low. So this is what you are now going to be trading. You are waiting for only this higher low to get entry. Price didn't come to higher low, and from here price moved higher. So this higher low is no longer valid. It's no longer your trading range. Here becomes your trading range. After price has created this high, this becomes your trading range. So price came, you want to wait for price at that higher low, at this higher low, to get an entry. So all your entries will be at these higher lows. All your entries will be at these higher lows. All of them. Price came to the higher low beautifully and created another high. When price created that high, this becomes your trading range. Let me remove this now. This becomes your most recent high, and then here becomes your most recent low. So this becomes your most recent low. So you want price to come back to this higher low so that you buy up. But now, while expecting to buy, what did you see? Price broke the higher low. That's now called a break in market structure. Price broke the higher low. Immediately price broke the higher low. It means that this setup is no longer valid. This higher low is already broken. It's no longer valid. So you are not going to be looking to get an entry. Coming out to remove this. Price has broken this low, so you are not going to be waiting to get an entry here. But rather, you now look at the new trading range. This is now the new trading range. This is your high. This is the last high that was created. Price is going back inside. Then here becomes your new low that was created. This becomes your new low. This becomes your new low. So this is the new range, trading range, the high and the new low. It tells you that this break in market structure, price has shift base, has shift momentum. So you want to now wait at the highs. You have to wait at the highs. This is the high for now. I just call this high. So you want to wait at this high to get an entry. I saw how that price came back to that high and gave you an entry. After price gave you that entry, created another low. When price created that low and started retracing inside, this becomes the low created, which is the lower low. Price created this lower low. Why is it a lower low? Because it is lower than this previous low. So you are going to be waiting at the lower high. The lower high. You have to wait at the lower high. This becomes your new trading range. This becomes your new trading range. Okay, let me leave this. This becomes your new trading range. This last high, which is your lower high, that's where you want to get entry. That's where you want to get entry. So price came to the lower high and gave you entry. Price came to the lower high and then you sell down. Instantly, price is retracing. Once you see price retracing, the next thing is to mark your trading range, the new range, the new low, lower high, and then the new lower low. This becomes your lower low, valid lower low, because it's lower than this low. So what would you be waiting for? That price should come into this next lower high for entry. And price didn't get to that lower high, gave you another lower low. Then you want to now mark out the new low, the new lower high, and then this becomes a valid lower low. You are waiting again for price to come back here, and then you can get an entry. Sometimes price will not give you that entry, but you have to wait there. If it doesn't give you that entry, if it gives a new low, then you wait for the new low. And all these structural points must be determined from monthly, weekly, daily, and the 4 hours from a higher time frame structure. If you are understanding what I'm explaining, just drop a 1-1 in the chat. Drop a 1-1 in the chat. Let me see. Okay, I'm going to talk about liquidity. Yeah, I'll do that. That's the aspect I want to go to now. You've seen how I spoke about structure. These are the components we use. The components we use before we take trade. Number 2, trading range. I've just showed you a trading range, how you identify the trading range. You go to the chart. Then now I want to talk about liquidity, the bands, and then the fib levels. That's what I want to talk about now. All right, thank you for your feedback. Let's go to the next page. Is this the log? Why is... Okay. Let's go to next page so that you see how we use this same setup. Okay. So let me talk about the bullish structure, for instance. Remember, I've explained that in the bullish structure, you only want to wait for price at the higher lows, So price comes and give you something like this. Give you something like this, and then price come, give you this. And then, okay, if it comes back, give you this. Okay. Yeah, this is something I want to do. Now we are bullish. First, structure. What is the structure? You know, price is bullish because price gave you this high, gave you this low, and price gave you this high. So we are bullish. So first component, you know we are bullish. The next thing to do is to get your trading range. This is your trading range. This is your trading range. And for your trading range, this is the higher low. Higher low. That's the only place I'm interested in for my buy setup. Then price comes, created this high, didn't come to the higher low, gave you another high. Now, this is not a valid higher low because price didn't come to this higher low before creating this high. So this is still the valid high. That's why I didn't mark this. This is still the valid high. Your trading range, This is the low, and then this is the high. So let me call this top range. Let me call this top range. Let me call this top range. Sorry, just give me some minutes. Okay, top range. I think it's necessary I write that because we're talking about trading range. So it's necessary I write that. I will write this down range. Center. Okay. Now let me put it below. Let me put it at the bottom. All right. So this is my down range. This is my top range. Now market comes and give you this. Remember I said this is not a valid higher low. So you treat this as a break of structure. It's okay, it's fine. You are not completely wrong. So let me write break in market structure. Or let me just write the correct thing so that you not be distribution. All right, let me write distribution there. So this is not a break in market structure. Why? Because price didn't come to this down range before price gave you the high. So this is a fake out. It's a fake low, higher low. This is the higher low, and this is the higher highs. Higher low, higher high. Maybe I should also put this one at the top, center, so that I can put higher high here. Let me put higher highs there. All right. So immediately you discover that price didn't come to the higher low and price moved from here. What you are expecting that immediately you saw this distribution, which we refer to as break in market structure on a lower time frame. It can give you 1 hour break in market structure here, fine. But we are bullish, so you are not expecting a good sale. If you get into this place, it's fine, it's okay. It's fine. It's not bad. Because you see that price swept this high, which we refer to as liquidity. This is liquidity. This is liquidity. Price took away these previous sellers, that's liquidity, and then price came and broke here. So immediately here broke on 1 hour, 30 minutes, 15 minutes, then you want to sell from here. You are right. But you must bear in mind that we are bullish. So price is still coming to buy. So even if you are going to sell from here, then you want to take your profit fast from this low immediately. Not to take your profit to come and clear here. It's not possible. You want to take your profit from this low. Because after this distribution, you are going to have this model. This is our entry model. This is how we enter the market. We must see this model, this formation. What's the formation? Price will come, first of all, buy up to deceive buyers that, oh, we are already buying. And then you will see them come with speed and sweep. A long candle will go down and we sweep the liquidity, telling you that, oh, we took your money. They'll sweep the liquidity and then break above. Price will come, break above. So immediately price broke above. This is now referred to as break in market structure or accumulation. This is a break in market structure. We are still buying. Remember, this top range is still here. So we're expecting that once immediately you see this, I'm going to show you on the chart, so don't be confused. You see price come. When price was retracing, what did you see? There was a high, there was a low, there was a lower high, there was a lower low. Then there was a lower high, a lower low, and price broke above this lower high. So this is a break in market structure. So what do you wait for? You wait for price to come back to this last push that took out these previous buyers, this push down. That's it. And here becomes your entry. So you wait for price to come to this push down, and then you want to wait in this zone. You zoom your eye to that zone. This is what you are waiting for. Immediately price broke above this. and then price is coming back to this entry. Here now becomes your entry, stop loss at this point, and then you go, you know, you are going to take target from this top range. Yes, this top range. If this link expires, I'm going to drop another one after 3 minutes. So let's go. You want to hold price to take profit from this top range. But price came to this zone, and what can you find? Price gave you another break in market structure or a shift in price in lower time frame, not higher time frame now, in the small time frames. Price gives you this. When price gives you this, just look out for something like this. Price might just come back and give you this same formation. If price gives you this same formation, then you're expected to get in again on the buy, because you are waiting for only buying opportunities in a bullish market. Take note of that. You are going to be taking only buying opportunities in a bullish market. So you don't want to look out for sell. If you want to sell, fine, you can just catch the sell and go out of the trade. But once it's a buy opportunity, you can risk your account, risk a good lot size on it, because you are trading with the higher time frame market structure. Then price comes, give you this formation, our entry formation, and then price goes up. Now let me talk about, I've talked about liquidity. These ones are all liquidities. These ones are liquidities that are taken. Liquidities taken before price gives you the model. Then the banks. The bank is this institutional candle, mitigation candle, or fair value gap that price will most at times give for entry. Then if you take your fib level from this low, since we are bullish, you take it from the higher low to the higher high. If I put it on this higher high, you discover that price came below 50. Below 50. Because 50 is equilibrium, above 50 upward is our premium zone, and then below 50 is discount zone. So price comes to the discount zone, give you that model formation, and price rallies away. Now price has given you another high. This high is only valid when you see it retracing. So this now becomes your next low. This becomes your range low. Then once this starts retracing, that becomes your top range. So you want to wait at this higher low again to get another entry. It may not be immediate, it can take time. So let's just look at one example. Let's look at VIX 25. I like using VIX 25 for almost all my entries, all my what's it called? All my courses, examples. I like using VIX 25. So look at this from here. On the weekly, we are bearish. Weekly, we are bearish. You can see this high, a low, a high, a low. You can see we're bearish on the weekly. But from this daily is bullish. This daily is bullish. So I'm going to consider only the daily to use that as my example before this time runs away. Okay, so let's talk about this bullish trend. This is daily. Remember, we're looking at market structure from the higher time frame. So this is daily. We are bullish. So what can you find? Price gave us a low. Price gave us a higher high, a higher low, a higher high, a higher low, a higher high. So if I wanted to get in this trade, this is where I'm going to be waiting for. I'll mark my range as price was retracing. This is my range. Top range, down range. The next thing I want to do is I'll bring out my Fibonacci tool. Then I want to find out if price is below 50%. So if I put it here, you see where price turned. Are you not seeing this 50%? Price turned from below 50% because that was already a discount zone. But price turned from this mitigation candle here. There's an order block here. You can see this order block here. That's where price turned. We have a video on order block already. Mitigation candle is in the group. Look for it and watch it. So price turned from below 50%. So structure were bullish. Trading range was there. Then liquidities were cleared. Where is the liquidity? Let me show you. I can remove this now because I want to talk about the next item now, liquidity. I'll talk of trading range liquidity. So where was the liquidity? Watch, this was the liquidity. You can see that liquidity there. That was cleared. You can see how this candle, sell candle, sold and cleared these previous people that were buying. People were buying this candle up. This candle came, boom, cleared them and pushed up. So immediately this candle cleared them and pushed up. We are expecting that price should come here and give us our entry formation, this break and retest. So if I come here, this is the place. Let me see if I can go to a lower time frame and see there is a break and retest that happened around this place. Let's check 1 hour. With that information, we can find it. Can find that information. Let's see. It's a long time. We may not find it. But if we can, to be good. Okay, I think we got it. We got it. All right. So now price came to this candle that sold down and cleared liquidity. You can see when price came there. Watch. Let's see. Price came into the box. What can you find? This was, as price was coming down, price gave us a high, a low, a high, a low, a high, a low. And price did what? Closed above here. Price closed above. You can see it is very clear. Immediately price closed above. Let's go back. When price closed above, you have to wait for price to come back into that candle that it broke. Price must come back to it. You just have to wait. It might take time, but price will come there. Certainly. So let's see. Price closed above. So this was the break in market structure. Break in market structure. Is the break in market structure. That's the break in market structure. Price went. Did price come back to it? Yes, price came back into it, moved, couldn't break above. Price came back into it. First, price moved. So if you were even playing this first move, you'd have been able to get almost a 1 to something. Let's see. So price came back to it. There was imbalance here. For those that know, that have already looked at imbalance, the video is in the group. You can check it out for imbalance. Price came into this place, your stop loss now at the low, then you enter at when price was coming back. This first move gave us a 1 to 3. That was a good one. 1 to 3 before price came back. When price came back, remember, we are still expecting price here to go up. So price must go up from here. You just have to keep your position. So if my position was here, let's say I entered from here and stop loss here, and then I wanted to take price from this high. Price came, didn't touch the high, came back into the candle, and then I know price is still going to go up. So I will hold my position still. Look at what price did when price came back. Price gave us high, low. You can see price kept giving us that same entry formation. You can see it high, a low, a high, a low, and price broke again. So immediately price broke again. I know that price is going to come back. Price came back. You saw how price broke up, price came back. So if I missed that first move, this would have been my second move. This would have been the second move. Let me remove this. If I miss the first move, this would have now been my second move in this imbalance. Then stop loss at this low, and then I want to take price upward. Look at what price did. Price rallied up and didn't come back. You can see that price rallied up and price didn't come back and gave us almost a 1 to 60. So if I held my position, let me go back to daily before this thing drops. We have a few seconds to go. Daily load, please, load. All right, this is daily, good. If I held that position down there to where price currently is, this is a 1 to 29. You are risking $1, you make $29. You are risking $10, you make $290. So this is a 1 to 29 trades by simply playing the higher time frame